different groups who regulate. And what we see that in having done some research, which I'll talk about in Europe and USA, there are often guidelines or recommendations made. And for consumer protection, frequently we see debt-to-income ratio and affordability are often cited with either some strict rules or broad guidelines. But what we also see is that it's affordability, or DTI, is often used because it's relatively easy to understand and implement. But when we get to regulation for prudent lending, we see much more move towards the credit scores, which were more effective for the control of portfolios. So we'll look at those two aspects and compare and contrast. So initially, I'll talk about some of the movements that have been made for consumer protection, and then we'll look at that and why scorecards can often provide better control methods than debt-to-income ratio. Some of the two of the main events that have triggered greater insight into and reaction from particular consumer groups was the subprime housing bubble, which pushed into action groups in the US and UK largely, but also more recently the ease of lending through the internet, providing reduced costs for the lender, providing short-term high-cost loans to often low-income groups, has also created reaction, particularly in the Baltic states, where high access to internet has meant that there's a large prevalence of these loans. But we're also seeing such things grow in countries like Georgia and recently in Russia. So going back to the housing bubble, certainly the biggest impact was on mortgages, and that's where, because it is a long-term burden on any individual, it has to be repaid and continually repaid, perhaps even as much as 24 years. I've just finished my my first mortgage that I had as a 23-year-old, and just repaid it all after 24 years. So it's a long time. So here we see the regulation from the Office of Fair Trading, which is a consumer protection body rather than a regulator in the UK, and really pushing the need for assessing affordability. But it's a quite broad requirement, which is looking at the fact that the lender has made an assessment which includes a broad aspect of elements to really review, and the onus is on the lender to be able to demonstrate that they have actually looked into the affordability. In the US, the CFPB, the Consumer Financial Protection Bureau, as recently as last January, introduced a requirement that the borrower's debt should not exceed 43% of gross income. But what's interesting there are a number of caveats, which meant that there could be exceptions based on excellent credit scores, significant assets, or accentuating circumstances to verifying income. So although there was a strict guideline, they had thought about some of the other components that could be used in responsible assessment of an individual's case. Looking now more at the internet loans explosion, particularly in the Baltics, we see in Lithuania that there's a guideline of 40% ratio of debt to income. But also we know the efforts that were made by Creditinfo Lithuania on behalf of the market to introduce information that gives a reasonable assessment of income through the state social insurance fund. And when speaking to lenders in the country, one of the things that's happened is often there is to meet the guidelines of 40% DTI, the loans have to be made over 12 months and offered over 12 months, whereas in reality, because individuals want to pay back over 3 months because it's lower cost, lower interest rates, they will actually repay over 3 months. So it's a sort of game that's in fact being played. The customer will say, I want this over 3 months. The lender will say, you can't, we have to offer you over 12 months, but there is an option to pay it over 3 months, which many of the customers actually do quite adequately, even though the DTI may be 100, 150% over the 3-month period. Latvia has got a similar approach, but this time they've made it dependent on the minimum income, and in some ways the having it lower percentages for smaller incomes makes it hit even harder those minimum income people, because obviously 10% of a small income is very relatively little. And again, this has been brought in by the Consumer Rights Protection Centre. Again, not regulators of banks, central banks, or it's the emphasis on consumer protection. We see similar trends in Turkey. Finland took a slightly different approach on the short-term loans, and that was to introduce a minimum APR. And that's the first one to really hit hard on that, and that I'm aware of, and has had a substantial effect with a number of lenders leaving the market in the short term. But what we're seeing now is that lending is more or less up to where it was when at the introduction of the new rules last July. So the lenders have found different ways of providing the needs of the customers.
Batem. No, to si můžeš stát, no jasně, takhle do toho mikrofonu bys slyšet.
When we move now away from the consumer protection regulators more to prudent regulation, and if we take an example of Basel II and the requirements there, we see that scoring and the use of scorecards is very much the predominant approach that's used. So one of the things that's quite interesting, if you look at someone like RBS Group, they're, as part of the IRB, the internal rating-based approach, they need to disclose how they make the calculations. And so you can pick up on the internet the way that they're making their assessments. And here we see for retail credit risk, scoring use models are the most material drivers of default. So very clearly the approach for portfolio control and prudential regulation. Another example is the OCC, the Office of Controller of the Currency in the US, one of the main regulators. And there they're using Bureau Score as one of the key classifications, and what they would require of, if you're going to declare a portfolio, a prime portfolio, it shouldn't have more than 10% falling into the subprime category. And with prime and subprime defined based on Bureau Score, typically. The other factor is where there has been a push for DTI and affordability. Frequently, income is not very well defined of what should be income. And we know that from all our experiences, to define income is a very difficult and inconsistent factor. So in a lot of countries, we might have up to, anything up to 70% of incomes being unofficial. And even where we know that perhaps it's a much smaller percentage, it can often be for certain individuals and certain groups of sectors of the employment, it's quite a high factor. So one of the areas that has been a lot of work is trying to support lenders in terms of defining what income is and how to make it verified. Because we know from some of the research that's been conducted by Creditinfo, if you look at monthly salary and you look at income that's not verified, you see, as in this graph on the left-hand side, there's no real relationship between income and default rates. Where we know that income has been verified, certainly there's a little bit more relationship, but still it's not the strongest information around. So the better we can define and verify income, the better it is. So as I mentioned before, Lithuania lobbied the state social insurance fund, and now dependent on strict access rules, a lender can have access to the tax salary of an individual to make a more accurate calculation of DTI. In the UK, they took a slightly different approach in the last 2 or 3 years. So really driven by the British Banking Association, all the banks are pooling the information on the credit turnover that goes through the current accounts. So when you get paid your income into a current account, what's known as the Cato group will actually assess a calculation to assess what your income is. And then when a new application is made, that the income that the individual states is then compared against the income that's calculated through the current account turnover estimation process. Again, even this, where we think we were looking at information at source, is quite difficult to calculate. You can see here time. We have the monthly indicators of turnover that's going through the account. We might have quite a lot of variation, particularly around bank holidays and short months, etc. And the other factor is we've got a lot of noise going on. If somebody is a single or multiple account holder, you might have one person with a regular job, someone with irregular income. So all those aspects need to be taken account, even if you're trying to work out what the average income is of an individual. Similar approach has been taken in Georgia, where Creditinfo has developed a process of not comparing against current account information, but comparing against previous applications. So if you declare on one occasion that your income is 7,500 Georgian lari, and then you declare in your next application for credits, possibly after you've been rejected, 12,000 lari, we'll get an alert that perhaps you're not telling the truth. You might be telling a little what we would call in the colloquial English porcupines or lies in your application. So then once you've calculated income, we still see that DTI does not necessarily have the strongest relationship to default. Here we have a lender that submitted some evidence to the in Latvia to the CRP to the regulators, and we see on the x-axis the DTI percentage. So normally, you would think it was impossible to pay more than 100%, but for short-term loans of perhaps 3 months, certainly the evidence shows it's feasible, and we see that the overall trend, looking at the line, is that as the DTI increases, that the default rate actually falls. Because by using scoring, they can actually select the lowest risk, which is a more important factor than DTI, to offer those individual short-term loans, which with the knowledge that they will actually repay. And this is some of the research that was done by the guys at Creditinfo Lithuania, looking at credit bureau data and Sodra information, so the D of the DTI coming from the bureau repayment and the I from Sodra, the income from Sodra. And we see there that only once the DTI becomes over 100%, do we see the default rate increase. So if we look at the quick loans on the left-hand side, we see that once the DTI under 100%, default rate is less than 4%, 100% it goes up to 12%. But even then we would see a bigger spread if we were to look at score. So again, not the most critical piece of data. And just a final example where we look at a Ukrainian scorecard for a Ukrainian bank. We see on the right-hand side, we see the score, and you look in the red line, you see the default rate go from more or less 0 up to 30%, whereas for DTI or PTI in this case, the default rate goes from 6 to 15. So the spread there of 9% in bad rates spread from 6% to 15, whereas we've got 35% when we look at the scorecard. So again, much stronger information using scoring. So just a little bit of a flavor that although the consumer protection groups are bringing in affordability and DTI requirements, we see actually in the evidence that scoring is a much stronger factor when it comes to risk assessment. Potentially the DTI is a good recommendation to provide certainly movement away from responsible lending, but as long as it's done with exceptions, if the lender can prove that through use of credit scoring or improved estimation of income, there are some exceptions. So that was really the background in terms of perhaps the European perspective. And what I'll do now is I'll pass over to Kenneth to give the specific situation that we've been seeing in Kazakhstan and the research that they did. And I hope you all read Russian. That's a joke. The rest of it is in English.
It is okay in Russian also. Emma, can you give me the right?
Yeah, there you go, Kenneth. You have the presenter rights.
Okay, thank you very much.
Okay, go for it.
Good day, everyone. My name is Kenneth Khalilov. I'm from First Credit Bureau, Kazakhstan. I'm a senior risk manager and I am dealing with modeling. So I'm developing application scoring, behavior scoring and different types of scoring models. Additionally, I also focus on some general retail lending market analytics. We make from time to time some customized analytical research to certain banks, and we decided to make this large analytical research, which I'm going to present you now. Well, a couple of words about First Credit Bureau. We were established in September 2004. 7 Kazakh banks are our shareholders, one financial group and Creditinfo. Until last year, actually, our bureau was mainly focused on provision of credit reports and credit stories, and only from November 2012, the whole management and actually the whole team in our company changed, and we started this new approach to develop more value-added products such as benchmarking, analytics, different types of scoring models, monitoring, and lots of different products. Let me tell you a little bit about the story in this country, actually why we decided to make this research. Last year in 2013, we had a rapid growth in unsecured retail lending growth. So basically, National Bank had to react to that extremely rapid increase, and they decided to make certain restrictions on unsecured lending. One of the restrictions was to introduce this debt-to-income ratio, which meant that banks have to calculate DTI ratio when they want to disburse a retail only unsecured loan, and the ratio must not be more than 50%. So basically, an individual must have some 50% airbag from his income. And the second is that National Bank said that starting from April 1st, 2014, banks cannot increase their unsecured loans by more than 30% per year. And so this was the reaction of National Bank. However, we felt that yes, there was a rapid growth of unsecured lending. However, we didn't. We thought that we must see if this growth rate is bad, whether our population is going to be over indebted, and whether this growth will lead to default in future. And we decided to prepare this analysis. Let's go through retail lending market review. So as you can see on this graph, retail loans share increased very significantly from first quarter 2012. It was only 26%, and in quarter one 2014, as of January 2014, it became almost 33%. So we can see that major banks, including traditionally corporate banks, switched to retail lending. Second, we can see that also NPL in retail lending also increased. You can see that in March 2012, in whole Republic it was 26%, and it reached 30%. The most rapid increase of NPL was in Almaty city. This is a major city of Kazakhstan. This is the first bar, from 34% to 43%. And I just wanted to know that when we're talking about NPL in Kazakhstan, you can see these quite high figures. These figures are explained by the fact that there is no bankruptcy law in Kazakhstan, and banks usually don't make write-offs. So basically, these high NPL figures are cumulative from 2007, after the mortgage bubble collapsed. So it became like with 43%, because this is cumulative figure. On the next slide, you can see labor force average outstanding loan amount. Basically, what we did is that we calculated a ratio. We took all outstanding sum of all outstanding loans, and we simply divided it by amount of labor force. And you can see that on the bars, again, in comparison to 2012, the average loan increased. increased significantly in all regions of our country. And if you watch at green and red lines, you can see that basically average outstanding loan to salary ratio also increased. It means that, for example, in Almaty, in 2012, average on average, individual must pay around 9 salaries to repay the debt, but in 2014 it became almost 10 salaries to repay the debt. However, if we look at the next slide, we can see the reverse trend. What we did here is we divided total outstanding loan amount not by labor force but by number of retail borrowers. And you can see that here, vice versa, average loan in 2014 decreased in comparison to 2012. And the same happened to this green and red line. Again, if we compare, we can see that average borrower had to pay like 8 salaries. Now, if we look at Almaty, average borrower has to pay around 17 salaries, and in 2014, only 12 salaries are required to repay the full amount of the debt. So we can see that trend reverses, and basically this means that banks are providing more smaller loans to a more large more large amount of borrowers, let's say. If we look at total outstanding retail loans, we can see that the figure again increased over these 2 years. The highest increase was in Almaty, it was plus 51%. So you can see that the growth was really rapid. On the next slide, you can see that number of borrowers as a percentage of labor force also increased. For example, if we can see the first bar for Astana city, in 2012 it was 57%, and in 2014 it became 91%. So it means that in 2014 almost every working person in Astana is having a loan. And we can see that this figure increased all over the Republic. Again, in Almaty it was 52% and it became 81%. Basically, you can see that number of borrowers increased more rapidly than the outstanding amount of the loan. And in summary, I want to show you the main trend. We can see that NPL as a number of subjects increased by 109%, but this increase might be due to some technical reasons, due to some loan banks restructurings and so forth. Excuse me. NBL, if we calculate the outstanding amount, it increased, but only by 54%. So the rate is twice smaller. These are like two negative trends. But if we look at Another 5 positive trends, you can see that average outstanding amount decreased by 21%, average outstanding amount to salary decreased by 33%. It means that now borrowers have to spend like less amount of salaries or need less amount of salaries, number of salaries to repay the debt. And you can see that the total number of contracts increased by 71%, and the total number of borrowers increased by 69%. Basically, we can see that these two trends are very very close to each other. It means that we have new lenders getting new credits. It doesn't mean that there are some borrowers who are taking second or third or fourth credit. It means that this is basically increase of number of borrowers. And you can see that outstanding amount increased only by 34%. Basically, it means that the growth rate of people is higher than growth rate of outstanding amount, and it means that banks are providing smaller loans to a larger proportion of population. And this analysis was done by Credit Bureau for the first time, and it was quite surprisingly, and it was quite convincing for the National Bank and for the bankers that basically, yes, we had a growth of unsecured lending, but we concluded that this growth is good by nature, and basically we don't have to limit it. On the next slide, you can see that we try to calculate the DTI and to compare over-indebtedness of Kazakhstan household with with indebtedness of households in different countries. What we can see here, DTI was calculated as annual income of a household divided by average loan amount. And you can see that statistically average household has to spend only 6 months income to repay the full debt. Basically, this is quite a good trend, because you can see that in different countries, the figures are higher than in Kazakhstan, and we are not like in very bad situation. However, if you look at the second graph, you can see that this household DTI was increasing in Kazakhstan for several last years, from 47 to 52%. Yes, there is increase, but it's not, very significant. It's just somewhere around 50%. So we believe it's not critical, and we believe that average Kazakhstan household is not over-indebted, and we don't see some macroeconomic risks here. On the next slide, we tried to understand why the retail loans was growing so fast, and we got to the following hypothesis that Generation Y, this is people who were born in 1980s in Kazakhstan. As you can see at the newborn number, we have got a demographic wave. The birth rate was quite high, and this large amount of people, around 3.8 million people, are now turning to 25 or 30 years. In Kazakhstan, this age usually people get married, and it means that they usually need some sort of money, because in this age you are relatively young and you don't have a large amount of savings, for example, to buy an apartment, but still you are married and you need some funds to buy apartment, and usually you go to mortgage. And we stated that this can be, this growth was driven by fundamental demand from these people. When I'm telling about the fundamental, I mean that people are not buying apartments, for example, just to resell them. So it's not like a bubble. This is a real thing. When people buy apartments to live there, not just to speculate on the price increase. And on the lower graph, you can see that proportion of borrowers aged below 30 years was increasing from 2009, and it increased from 29 to 34%, and it means that basically a larger proportion of young people are becoming clients of the bank. So we had made several conclusions. Were the high retail lending growth rates in 2013? Yes, definitely yes. And what was the causes of the growth? Was it responsible lending or borrowers over leveraging by the banks? We can say that no, it wasn't, and this was the main basically concern of the national bank, that local banks are just providing loans to the customers, and customers go to default because they are taking too much leverage. And on the figures we saw that no, it is not the truth. National Bank should not be concerned by irresponsible lending. Banks are actually good lenders. Was it deferred demand from inactive post-crisis period in 2008, 2010? Well, maybe, but we don't know for sure, and we believe that the correct answer for this question is that there is a fundamental demand by the Generation Y. However, we understand that these are only hypotheses about Generation Y, and we need to make some additional research to prove that this hypothesis is true or not. And let us move to the second part of my presentation. I was trying to find the relationship between DTI and probability of borrower's default, and the result was actually, as in previous countries were co-presented, that it didn't have much predictability. So for the research, we used definition of default is a borrower who has 90 days past due on any loan at least once during the service period. We used 3 different periods. Excuse me. Now, why we used 3 different samples is because we needed to test how this DTI was affected by different sampling methods or by different factors. And sample one, we can call it full sample. It was loans which were provided during March, from March 2012 to March 2013 for 1 year. Second sample, we can call it February sample. It was loans which were provided on February 2013. And the third sample, we can call it no fix sample, is basically the first sample. But we excluded individuals whose income was below 210,000 tenge. This is around slightly less than 1,000 euro. Also, we couldn't calculate DTI according to requirements of National Bank because basically the requirement was not clear, and the regulatory legal act that was issued by National Bank was, it was a big question because the bank had so many methodological questions on how to use it, how to calculate, and basically that is why we had to use proxy indicators instead of following direct requirements of that regulatory legal act. Now, for installment loans, we use monthly installment amount according to loan repayment schedule, and we assume that for credit card, borrowers will repay 5% from credit limit monthly. For proxy B, we said that actually the same as proxy A, but repayment for credit cards is 10%. And proxy C, this is basically what requirement of National Bank, that outstanding amount you just divide by loan term by month. However, you can see the research result. You can see that whenever we calculated this DTI with three proxies, you can see that yes, as DTI increases, the bad rate also increases. And from the first glance, you can see that DTI has some discriminatory power. But you can see that bad rate basically is in the range between only 5 and 35 or 40%, which is not so good. And you can see that behavior score has a much better distribution, and you can see that it fluctuates between 0 and almost 100%. So behavior score is definitely much better. So whenever we calculate it, we saw that Gini's for all proxies of DTI was quite low, and Gini for behavior score was quite high, around more than 70%. It's more than enough, basically. And below you can see that DTI is also subject to some limitations. For example, it has seasonality. DTI does not have strong discriminatory power, and DTI basically have lots of shortcomings, and that is why the Gini was low. But basically, why DTI is not a very good predictor is that DTI takes into account only a formally agreed relationship between bank and borrower, without considering other circumstances that arise in borrower's life. For example, if a borrower drives a car and have a car accident, so he have to spend some money to repair the car, and DTI doesn't take this into account, and this 50% airbag is usually not enough for the borrower to make his some extraordinary unforeseen costs. However, behavior scoring takes into account such difficulties of life, difficulties in borrower's life, because if a borrower, let's say, is a loser, he is in car crashes like every month, it means that every month he will have problems with debt repayment, and that is why he will have some past dues, he will have some problems with credit discipline, and this will be reflected in his behavior score, and that is why behavior score is much better predictor than DTI. And hypothesis is that why DTI didn't work very good is that except for loans, actually borrowers in Kazakhstan have a bunch of different extraordinary events that doesn't let to predict their default with a high probability. And in recommendations, we said that it is better to use tools based on behavior score rather than only DTI. It is better to use household DTI, and in general, like if possible, banks must rely more on behavior scoring. Additionally, banks actually require that our credit bureau would introduce some periodic retail lending market analytical reports. After they saw our presentation, they was quite interested in this analytical report, and additionally, we said that if required, FCB can help the banks, the national bank, to calculate this DTI on the basis of our database. So that's it from my part. Thank you for your attention.
Thank you very much, Kenneth. That was brilliant. Thank you, and really showed the importance of the Credit Bureau providing support to regulators and to banking institutions with our unique, let's say, global perspective of the market, often which the regulators without that will make uninformed decisions based on one or two headline figures. So I think that's excellent and well done on a challenging subject to do in English. So thank you very much.